we will be seeing about what is a cash flow basic or cash flow statement basics. Okay, so basically cash flow is one of the important tool, okay, which the finance manager is using for ascertaining the changes in the balances of the cash in hand as well as bank from one date to another. So cash in hand and bank balances. Okay, so statement of cash flow will show why are there changes in the cash in hand or bank balances from one date to another. So cash flow is statement is prepared for a specific period. Okay, for a specific period. Okay, so say it may be prepared for a quarter or for a particular year or 6 month or monthly cash flow. So this, say this is a cash flow, cash and bank balance at the beginning of Jan. Okay, and then there is a cash and bank balance at the end of Jan. So cash flow statement will analyze why are there changes in the cash balance and the bank balance during the month. Okay, there will be some increase, some decrease in the cash balance. So what are the reasons for that will be analyzed by the cash flow statement. Okay, now let's see how do we prepare a cash flow statement. So this is a format of the cash flow statement. Cash flow statement for the period so and so. Okay, so period from so and so. Okay, or it will be cash flow for the period or for the year ended or for the quarter ended or 6 month ended or for the month ended also. Okay, so it usually begins with the opening balance, that is cash balance, and the bank balance including OD and CC. Okay, opening balance at the beginning of whatever period is considered. Okay, then how is it analyzed is you have to bifurcate all the cash inflows and outflows into three basic activity. One is cash from operating activity, other one is cash from investing activity, and third is cash from financing activity. Okay, so once all these adjustments are made, whatever is the final addition and subtraction, okay, you should be getting a closing balance of total of cash and bank balance including overdraft and cash credit as at the end of the period whichever is considered. Okay, so it should match with the closing balance. Now let's take all these activities one by one. Cash from the operating activity. Now as the name itself suggests, operating activity means whatever is the cash outflow or inflow from your operations. Okay, now there are two methods of calculating this cash from operating activities. Okay, so one is your direct method and one is indirect method. Okay, so in direct method what we do is we take all the direct method means we take all operating income, okay, that is your sales, okay, or service fee, professional fee, whatever are the operating income, and reduce all the operating expenses from that. Okay, so that you get the cash from operating activity. Okay, now operating expense means you reduce all cash operating expenses from that. Now indirect method. So what is the indirect method is you take a net profit as per P&L. Okay, then you have to add all non-cash expenses. Non-cash expenses like depreciation, okay, or writing off of expenses and so on, we have to add it. Okay, then you have to add all non-operating expenses. Okay, so for example profit on sale of some machinery, okay, or if there is some interest expense you have to add it. Okay, then you have to reduce your non-operating income if any, that is your interest or dividend received from non-trading investments, okay, and so on. So once you do that, what you have to do is you have to do an adjustment for your working capital, okay, that is your current assets and current liabilities. Okay, so the simple rule is if there is an increase in the current asset, okay, that is your closing balance at the end of the period, if the current asset is more than the opening balance, there is a increase, you have to reduce it. Okay, okay, if there is a decrease in the current asset, you have to add it. Okay, now for liabilities you have to do it vice versa. For liabilities what you have to do is increase in current liability, you have to reduce it. Okay, and decrease in current liability, we have to add it. Now why are we doing this working capital adjustment? See, when we take this direct method or indirect method, okay, so whatever are the expenses or income we are considering, okay, in that we have both all types of expense. We have an expense for that particular period. Okay, when we prepare a profit and loss account, we have sales for that particular period, irrespective of whether it's a credit sale or cash sale, a money is received for credit sale or cash sale or not. Okay, irrespective of that, we have a credit sale for that period and a cash sale for the period. Similarly, for the expenses also, whether the expenses are payable or paid, okay, the total expenses of for that period are included here. Okay, when you consider your net profit as per your profit and loss account, as per accrual system of accounting. But since we are preparing a cash flow statement, we have to calculate what is a cash inflow and outflow from the operating activities. Okay, so if say there are credit sales, okay, but only 80% of the amount is received from the debtor, balance 20% is not received, we are not considering that 20% in cash from operations, we are considering only 80%. Similarly, when there is a particular expense, say an expense is outstanding for a particular month, we are not considering that as a cash outflow for that period, as there was no cash outflow, right, the expense was outstanding. Similarly, if the expense is prepaid, okay, the same is not considered in your profit and loss account, correct, but for the purpose of your cash flow statement, we will be considering that prepaid expenses, there was a cash outflow for operating activities, okay, for the particular period. That is why we need to make these adjustments for working capital. Now if you see the logic, increase in the current assets, so increase in the current assets means was increase in either your debtors or loans and advances or prepaid expense. So when there is an increase in your current asset, okay, the cash flow to that extent is accumulated in your current asset. Okay, so that much cash inflow is less, that is why you need to reduce it. Okay, similarly, there is a decrease in the current asset, okay, that much money has to be added to your cash flow. Okay, and the same logic needs to be applied for a current liability also. Okay, now this is how you get a cash from operations. Okay, now what we'll do is we'll see what is a cash from investing activities. Okay, so what is the investing activity? Investing activity basically means purchase or sale of assets, okay, or any investments. Okay, right, so Purchase or sale of asset or investment is a investing activity. So whenever there is a purchase of asset or investment, okay, there is a outflow of the cash, so you have to reduce it, right? So whenever there is a sale of asset or a sale of investment, there is a inflow of the cash, right? So you have to add it, right? So this is basically investing in activities. Now what is a financing activity? Financing activity means whatever are the payments made to your long-term funds, right? That is your share capital, your loan fund, okay? So this will include your when you issue the debentures, issue of debentures, when you receive the proceeds from issue of debentures, okay, this is a financing activity. So you are receiving the money, so it will be added. Then issue of shares, you receive the money, it will be added. Dividend paid, okay, now remember here dividend paid we have to consider and not the proposed dividend, right? Because proposed dividend is not yet paid, okay, so we have to consider only the dividend which is actually paid. So since we are preparing a cash flow, so dividend paid we have to reduce. Then debenture interest paid to reduce, okay. Then loan taken from bank or from any other party also, we have to add. Loan repaid we have to reduce. Interest paid on loan we have to reduce, okay. So then similarly issue of debentures and issue of shares, we are adding it, okay. Say we are repaying the debentures or shares, we have to reduce it, okay. So this is how you prepare cash from operations or in operating activity, cash from investing activity, and cash from financing activity. And at the end what you should be getting is a closing balance, total closing balance of all your cash and bank, okay, including overdraft and cash credit, which is at the end of that particular period, okay. So this is one of the way in which you can cross check whether the cash flow statement that is prepared is correct or not, okay. So this was about a cash flow statement, okay, basics of cash flow statement. Thank you.